Can't comment on any specific plans we have at this moment in time.
Plus, Siemens Healthineers buys Varian Medical Systems for $16.4 billion. And 7-Eleven's parent company brokers a deal for Speedway gas stations valued at $21 billion. Matt, good morning. Futures are a bit mixed, but it's been very quiet in terms of M&A, but we had quite a bit of news this morning as well as over the weekend. That might potentially impact markets today.
Yeah, a lot of M&A news over the weekend for sure. And also this gives Siemens Healthineers the chance to change that name if they want to. In terms of futures, we're looking at kind of a mixed picture. The cash trade starts right now. Let's open up the global macro movers screen on the Bloomberg terminal here. It shows you a number of risk assets across different columns, and the left-hand column is where the live equity indexes will start popping up as they open up. You can see the FTSE's already opened down 0.1%. Up 0.1%. No, sorry, it's unchanged now. But it's bouncing back and forth between gains and losses. Here we have a real mover at the top. The DAX has just opened up, gaining 0.5% right now. You can see the CAC 40 under it, up about 0.3%. And if you look here, with the exception of Spain, most of the European markets are now trading higher. The AEX is up 1/3%. The Euro Stoxx benchmark is up 1/3%. So markets rising a bit there. Siemens Healthineers is buying Varian Medical Systems for more than $16 billion. We spoke to the CEO a short while ago regarding this deal.
It's a combination of a cash and equity raise, which will follow in due course. This equity raise will create also additional free float, which eventually will lift us in the DAX. We are very certain about this transaction. It's the right time, and we are also super confident about financing.
Joining us now is Bob Parker, investment committee member at Quilvest Wealth Management. Bob, thanks for joining us this morning. Let me get your take on the M&A season thus far. It has been relatively tepid. Of course, it's probably more difficult to make deals when you can't leave your house. But do you expect it to pick up now, given the volatility in markets?
I think the answer to that is probably yes, but are we going to return to sort of the very high volumes of M&A, that we saw in sort of 2018 and 2019? I think the answer to that is probably not. But we do have obviously a backlog of deals that haven't been done in the last 2 to 3 months for obvious reasons. So I think that backlog certainly is going to start to get cleared. And clearly we have financial conditions are positive in the terms of nominal and real bond yields are very low, credit spreads are very tight. And investors are still relatively long cash. So the financial backdrop, I think, is positive. And I think that as we go into late third quarter, early fourth quarter, I think a focus probably in the healthcare sector, IT, telecoms, to some extent consumer staples as well. I think those are the areas which M&A will pick up.
Bob, is this just opportunistic, or can this have a real impact on Europe's recovery and the real economy?
Well, I think the first point to make is that, all the data that's coming out of Europe, and, we're going to get quite a string of data this week, which is very important for investors. But, if we look back in June and July, we actually have seen signs of a sustained recovery in the Eurozone. So I think the economic backdrop for European activity and M&A activity is positive. And, whereas I've got some questions over, third quarter US growth, and I think investors may be disappointed. I think if anything in Europe, I think the surprise is going to be to the upside, and we could easily see some quite strong quarter-on-quarter GDP numbers, and that in turn, apart from the easy financial conditions, plus obviously the fiscal expansion we've had, is a positive for coming back to Matt's question on M&A activity.
Yeah, you know what I'm looking at on the MA Go page, you can click the time series tab and look at the amount of deals going back. We've had an incredible, really almost 10 years of deals behind us, Bob. But if you look right after the great financial crisis, there was a huge lull, not just 2009, 2010, but all the way into 12 and 13 as well. I guess because that was a financial crisis, and we've thus far avoided that. Maybe, thanks to the FSB and their too big to fail regulation. Do you expect us to continue to avoid a financial crisis? Because we're starting to hear about loan losses. HSBC says it could be up to 13 billion. We had big numbers out of Spain last week as well. Do you expect a financial crisis to come?
The answer to that is no. And I think if we look at what's happened so far in 2020, it is a severe demand and supply shock. And, that's clearly reflected in, the second quarter activity numbers, in all the GDP numbers across the developed economies. And, the only economy that actually saw positive growth in the second quarter was China. Now, I think what's very different between now and 2008, 2009, is that the financial system, despite the provisions which are being announced, at the moment, and we've seen HSBC this morning, despite the heavy provisions, I would argue the financial system is very resilient. And if, for example, you look at leverage ratios in the financial system today relative to 2008, the financial system has extremely de-levered compared with the very high levels of risk and leverage that we saw prior to the financial crisis. So the answer to your question is I would be very surprised if we see any financial. We're going to see financial pressure, but I don't think we're going to see any failures or shocks.
You don't think we're going to see any failures? I mean, the United States really just a slew of bankruptcies. Is that going to happen in Europe?
Well, let's. I think one has to make a very clear distinction between Matt's question, which was, are we going to see failures in the financial system? And my answer to that is no. If we look at corporate debt, most of the credit rating agencies are forecasting that default rates in the high yield market, which currently are running just over 5%, probably will increase to over 10% by the end of this year. And in the first quarter of next year, we could see default rates as high as 12 or 13%. So I think investment grade corporates, I think default rates there are going to stay low. I think credit spreads will remain tight. But I think if you're going to look for pockets of problems, clearly the high yield market is going to diverge and is going to underperform the investment grade market.
All right, Bob, we fortunately have we have a couple more blocks with you, so we're going to keep you with us here. Bob Parker is an investment committee member at Quilvest Wealth Management, and he's so much more, so we're glad to get time with Bob. Coming up, HSBC, as we mentioned, missing estimates as political upheaval in its biggest market hurts it, and rising bad loans weigh on the lender as well. We're going to bring you our exclusive conversation with the Chief Financial Officer of HSBC, Ewan Stevenson, next. This is Bloomberg.
morning. Welcome back to the European Open. We're just 10 minutes into the trading session. The FTSE 100 is relatively flat, but the DAX are on and the CAC are higher this morning. A tentative rebound from the two-day slide we did see at the end of July last week. Let's get the business flash now. Here's Laura Wright. Laura, good morning.
Thanks, Anne-Marie. 7&I is buying Speedway gas stations for $21 billion. The owner of 7-Eleven is hoping for an expanded U.S. footprint will deliver growth amid the pandemic. The deal will be paid in cash and partly financed with debt. It's the biggest ever deal for retail giant 7&I. It currently has around 69,000 stores worldwide. Siemens Healthineers has agreed to buy Varian for about $16.4 billion in cash. It's the biggest medical acquisition of the year. The deal will be financed through debt and equity. It gives Healthineers a sizable market share in the rapidly growing field of cancer treatment. It also opens a potential path onto Germany's benchmark DAX index. James Murdoch is cutting ties to the family empire led by his father, Rupert Murdoch. That's after clashing over its editorial direction. He was chief executive of the family's main media business until last year. He stepped down when most of its assets were sold to Walt Disney. Since then, he's become increasingly critical of the conservative editorial direction at News Corp and Fox News. That's your Bloomberg Business Flash. Anne-Marie, Matt.
Laura, thanks very much. Laura right there with your business flash. Now, HSBC is warning of up to $13 billion in loan losses for this year alone. And profit for the quarter fell by 57% from a year ago. That's as the bank was weighed down by the pandemic, as well as the political upheaval in its biggest market of Hong Kong. HSBC now says it will accelerate its planned cost cuts. The lender is expected to eliminate about 35,000 jobs. Earlier on, Bloomberg Television spoke with the CFO of HSBC, Ewan Stevenson. Daybreak anchor Manus Cranny asked him about the reasons behind the new credit loss guidance.
We've incurred just under $7 billion of expected credit losses in the first half. The businesses most impacted are the UK. We had $1.5 billion of additional credit losses in our UK ring-fence bank. And commercial banking amongst the customer segments, where just over $2 billion of expected credit losses. I think the big driver in the second quarter, though, was a very big shift, negative shift in terms of the economic outlook for the global economy in 2020, with a recovery in 2021, but not enough to offset the sharper recession that now everyone's expecting this year.
Ewan, you're expecting about $500 million in cost savings in the second half. Is that program going to get accelerated going forward? And is sort of the targeted cuts of around 35,000 still going to be sufficient, or does that get changed? Does that need to be increased?
Well, we're pretty pleased with the progress we're actually making on cost. We went into the start of the year at the full year results anticipating the costs were going to be flat. We're now signaling we expect them to be down at least 3% this year. We had a 7% reduction in the second quarter. It was flattered somewhat by very subdued activity in the bank on things like travel and some of our head office costs. So we're on track to deliver what we announced in February, which was a substantial cost reduction program over the next 3 years. We're pleased with the progress that we've managed to achieve in the first 6 months.
Ewan, look, you had that banner headline, 35,000 jobs to go. You paused, you've restarted. Is there a reality moment that we need to face that the job cuts and the reorganization is going to mean more than the 35,000 that you and Noel guided at the start of the year? We're looking at something much more substantial.
It was never a target in terms of headcount. Where the target was to take our cost structure down. We've had about just under 4,000 employees and contractors leave the bank in the first half of this year. We did what we thought was the appropriate thing to do back in March and pause that redundancy program. We've restarted as of a month or so ago. It's speculation as to how many people it will involve, but we do need to take costs down given the revenue pressures that we're now seeing in the bank as a result of COVID.
I mean, speaking of COVID, much of your guidance depends on a variety of scenarios coming from where the economic recovery is going to go from here. From what you see in the data, from the conversations that you've been having with some of your peers in the industry, what are the next 3 months going to look like?
I mean, there is a substantial amount of uncertainty out there at the moment, whether it be geopolitics, whether it be Brexit, whether it be COVID. I think over the next 3 to 6 months, it will be important to see the impact of second, third wave and what impact that has on various economies around the world. And also, you know, what the path is to a viable vaccine sometime in 2021. So I do think we'll learn a lot over the next 6 months or so as we approach full year results. We should also get some clarification on the path of Brexit as well over that period. And that's why we've come out today with quite a large range of expected credit losses this year of $8 to $13 billion.
That was HSBC CFO Ewan Stevenson speaking to our Middle East anchors Yusuf Gamaldin and Manus Krani. Now, we do have some breaking news crossing the Bloomberg terminal this morning. Spanish PMI rising 53.5. That beats the estimates. The forecast was for 52.3. And of course, anything over 50 is growth. Let's get the reaction now from Bob Parker, investment committee member at Culvest Wealth Management. Still with us. Bob, what do you make of this? Because of course, the Spanish GDP number came in much worse than was expected. We are getting a better print on the PMI.
Absolutely. If you look at the GNP numbers for the second quarter, you know, obviously across the whole of the Eurozone, the numbers were exceptionally bad. That was mainly driven by the shock to the Eurozone economy in April and early May. And the pattern was that the Eurozone economy then started to form a base in late May with recovery in June, and that has been continued in July. And that is consistent with the upturn that we have seen in the PMIs. And I think one word of caution on the Spanish PMI is obviously Spain has got a renewed coronavirus problem. I think that well could be a challenge for Spain in the August and September data. And, you know, obviously their tourist industry, which is very important for the economy, it accounts for over 10% of the Spanish economy, is going to experience a very tough month in August and going into a...
Good morning, everybody. Welcome to SG Trader live stream and day trading channel. I'm placing a new order to buy Japanese yen at 105.868. The order placed, and it's I'm waiting for confirmation from my broker. I'm still waiting, so I'll let you know when the order was executed, okay?
In Spain, and notably around Barcelona. You know, the authorities have had to react very robustly indeed. But I think as opposed to a sort of nationwide problem, they are now regionalized or localized, and we see that likewise in the UK. I think the second observation is I think the authorities, whether it's the health authorities or other parts of government, have learned the lesson that they acted probably too late back in February and March. And consequently, the responses that we're seeing now are much more rigorous than we saw earlier in the year. And, you know, I think the Spanish authorities have reacted, you know, very strongly indeed in the last few weeks. So to that extent, I think we're in a very sort of different situation and the impact on markets than we saw, you know, back in March, when obviously there was this very severe shock with that severe fall in both credit markets and equity markets.
Yeah, that's actually our MLive question of the day, Bob, about these fresh lockdowns. What's the impact on equities? Are fiscal monetary measures good enough to look through the impact of potentially fresh lockdowns?
Well, first of all, let's talk about sort of monetary policy. And I think one has to make a very clear distinction between what the Fed is doing and the ECB. Obviously, at both their recent meetings, the July meetings for the Fed and the ECB, both central banks were essentially on pause, and they decided that further monetary action wasn't required at the moment. And that's against a background, obviously, of a very dramatic expansion in monetary policy that we saw in the sort of period from March through to early June. Now, in terms of where we go from here, obviously, the coronavirus is, I think, much more of a challenge at the moment in the US. And we've recently seen a negative impact on consumer confidence and certain activity numbers, particularly in the southern and southwestern states, are starting to reverse. So I do think that actually August and September, we're probably going to see an expansion in the Fed balance sheet. That could easily go from where we are at the moment, 7 trillion, up to over 7.2 trillion in September. So monetary easing in America, I think, is highly likely. If we get, as I think, probably these localized problems in Europe, then I think the ECB probably just continues with its current program and won't accelerate it. So divergence between the ECB and the Fed. The fiscal programs, obviously America is critical what's going on at the moment, and will Congress come to a deal on a fresh fiscal stimulus? And that is required. And if they don't come to a deal, then I think the S&P is going to have a problem over the next couple of weeks.
Right, and will it be big enough? Bob, thanks so much for joining us. Bob Parker is an investment committee member at Quilvest Wealth Management. He's also governor at the King's College School, and he's going to be continuing this conversation with me on Bloomberg Radio at 9 a.m. UK time. Definitely tune in for that. If you're in the city, you can just turn to Bloomberg on London DAB digital radio. Anywhere else in the world, just Google Bloomberg Radio and you'll find it. Coming up, we're looking at the stocks on the move, including Siemens Healthineers, which is now sliding after its $16.4 billion deal to buy Varian. Second day in a row of drops on this. This is Bloomberg. welcome back to the European Open. We are 25 minutes into the session, still looking at a mixed market with the FTSE down almost 0.5% in London, the DAX up more than 0.5% here in Frankfurt. Let's take a look at your big movers this morning. We've got HSBC falling after warning that loan losses could reach $13 billion this year, and after profit fell more than had been anticipated by analysts. Siemens Healthineers is down more than 5%, or about 5% right now after a $16.4 billion deal for Varian, and Morphosis right now. You can see rising 7.5%, got FDA approval of Monjuvi in combination with lenalidomide for the treatment of adult patients with lymphoma. So a very important treatment there that I think everyone hopes is going to work out well. Anne-Marie?
Matt, coming up next, we're going to talk about the Portuguese economy. It shrank 14% in the second quarter. The pandemic brought the country's tourism industry to an almost complete halt. Up next, we're going to speak to the Portuguese tourism minister. That's Rita Marques. This is Bloomberg.
I'm canceling the order to buy Japanese yen. It takes too long to execute, okay? I'm placing a new order to sell short British pound at 138.5. So order placed to sell short British pound at 138.5. Moved too fast, too quickly, so I have to cancel the order.
Welcome back to the European Open. We're 30 minutes into the trading day, and the benchmark index, the SOX 600, is trading lower. We're down nearly 0.3%. And some of the sectors that are really weighing down the index this morning is travel and leisure, down 1.5%. No surprise there, given the fact that there is this worry about resurgence of coronavirus cases. Also, banks down more than 1% this morning. Financials under pressure as HSBC warns on those loan losses. They may reach $13 billion this year. So right now, across the European equity markets, we do have a risk-off tone this morning. Now, for some more news, let's get the Bloomberg First Word News with Laura Wright. Good morning, Laura.
Morning, Anne-Marie. The US plans to act against a wide range of Chinese-owned software companies, not just TikTok. That's the latest from US Secretary of State Michael Pompeo speaking to Fox News. On Friday, President Donald Trump told reporters he planned to ban the popular video app. No official decision yet, but Pompeo says it should come soon. The UK is considering the worst-case scenario of locking down London again. That's according to the Sunday Times. It would include travel curbs in and out of the M25 and would see at-risk people asked to stay home. Local Government Secretary Robert Jenrick says he is not aware of any specific plans to seal off London, but that the UK will target local flare-ups rather than blanket action across the whole country. A hard lockdown could deliver a faster economic recovery. That's according to Minneapolis Fed President Neil Kashkari speaking to CBS. He says while the move would be very unpopular, it could restore growth and hiring more quickly rather than waiting for a vaccine. Kashkari also said the surging US savings rate means the country can afford to finance more fiscal aid. Global coronavirus cases have topped 18 million. The pandemic is now adding around 1 million new infections every 4 days. Australia has expanded its restrictions in Melbourne in an effort to curb rising infections in the city. New Zealand is now delaying its quarantine-free travel zone with the country due to the outbreak. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anne-Marie, Matt.
All right, Laura, thanks very much. Laura right there with your top news. Now, the Portuguese economy shrank 14% in the second quarter. The coronavirus pandemic brought the country's tourism industry to an almost complete halt. And Portugal, which has the third highest debt ratio in the euro area behind Greece and Italy, is now trying to attract tourists back. It is estimated that tourism there accounts for 15% of GDP. Joining us now is Rita Marques. She is Portugal's tourism minister. And Rita, first off, what can you tell me about, hopes to bring back tourism as these second waves around Europe start to flare up, or at least pockets start to flare up, and the UK has told tourists coming back from Portugal they must self-isolate for 2 weeks?
Hello, Matt. Thanks for having me. Yeah, we have been working since day one. So although, as you said, tourism stopped here in Portugal, we had a decrease on activity of around 97%. So everything stopped, basically. We have been working since day one, developing specific projects in order to instigate trust. Trust is something really, really important to all of us, very dear to all of us. So we've been welcoming everyone, and at this stage, we are fully open. All the rules are known, and people are visiting the country. And I guess that if you comply with the rules, you'll be safe. That's the main message that I have to convey to you today.
Rita, good morning. It looks beautiful where you are in Porto, Portugal. I want to ask you a question about the UK decision to tell travelers that travel to Portugal they need to self-isolate for 14 days. Is Portugal going to retaliate? Are you in talks with the UK to mitigate this?
Yes, of course. We have been in contact. We have been in close contact with the UK, providing all the information requested by the British government in order to facilitate the decision by the UK. So the situation here in Portugal has been evolving positively. We have a ratio of under 20, so under 20 per, so new cases per 100,000 inhabitants. That's slightly below the threshold used as a reference by the UK government. And so we have been providing all the information. We are not sure when the decision is going to be revised. But of course, we are not going to retaliate. Since day one, Portugal has considered that quarantine is not really the solution to this pandemic disease. It's something worldwide that has been, happening everywhere. It's a worldwide phenomenon, and we do not believe that quarantine is really the real solution. People should be tested at the origin, ideally. If that's not possible, at least people, when coming to Portugal, they should comply with the rules, and so far so good. So the situation is under control, and even in the first wave, back in March, we complied. The situation was under control, and so we feel that for the upcoming weeks, for the coming months, we will be okay.
I hope we'll be able to go back to the ECB's forum on central banking at Sintra in November. It's always a highlight for me, but until now, people have been canceling trips to Portugal. You've got what's going on in the UK, but I have a lot of friends who live in Galicia who go down there a lot and haven't been because of the virus. This has to be horrible for hotel owners. It's obviously horrible for restaurant operators. Are you planning some kind of fiscal package in order to bail out the people who rely in Portugal on tourism?
It's something that we have been analyzing continuously. It's something, unfortunately, this situation is going to produce. It's not going to stop right away. So the government has disclosure two strong aid packages. First back in March, another one a couple of days ago, and so we have been evaluating the situation in a daily basis. And of course, we cannot close the door to anything right now. Of course, August and September, our month we are in the peak season. So although, as you said, we are not welcoming all the people that was here last year, in fact, we have been attracting a couple of events, very popular events. Formula One will be. We will be hosting Formula One in October, and also the championship, the football championship, soccer championship. And so we do believe that August and September are going to be strong months, and again in October, November, December, let's see how it goes.
What about bailout money for hotel operators? Is the government starting to work on a package?
We have approved a layoff scheme. So basically, all the hotels, in order to avoid unemployment, so all the hotels and tourism animation and all that, so they have been supported by the government, by Social Security, in order to maintain jobs. That is our first priority, and we'll continue to have that type of approach in the short term. Of course, unemployment is really something that we really need to avoid. And for that reason, we have been, benchmarking with other countries, negotiating also with the European Commission in order to see if we have, the right type of incentives to secure jobs. That's our main priorities right now.
Rita, thanks so much for joining us. Really appreciate your time this morning. Rita Marques is Portugal's Secretary of State for Tourism and Industry, incredibly important to that country's economy. Now, let's talk about really, really rich people. The richest family in the world is the Waltons. The Walmart owners have become the first family to top the $200 billion mark. Up next, we're going to discuss Bloomberg's annual rich family list. This is Bloomberg.
Welcome back to the European market. We're 41 minutes in today's trading session. The FTSE 100 and the CAC 40 are under some pressure this morning, but the DAX is up more than 0.6%. Now, the Walton family is worth more than $200 billion. This is according to Bloomberg's annual Rich Family list. The owners of Walmart have added $25 billion to their wealth in the past year alone, and they haven't only become richer despite this pandemic, they've actually got richer because of it. So here with more is Bloomberg's wealth reporter, Ben Stupples. Ben, thanks so much for joining us this morning. Let's start with the Walton fortune. Can you break down the details?
Well, I think what we've got here is a case of, as you just said, a family that's a retail fortune that's invested over the years, significantly into e-commerce. So, of course, the Waltons and Walmart definitely wouldn't have predicted the pandemic, but they were definitely well prepared for something like this to happen, as consumers flocked online to e-commerce, but also bulked up massively in brick and mortar stores. To put it into perspective. Yes, as you said, they're worth $215 billion. Overall, the world's 25 richest families held steady in comparison to the previous year, a total net worth of about $1.4 trillion. And to put that into perspective, that is about half the GDP of some developing nations, including where I'm sat in the UK.
So that's the Waltons are one family that's gotten richer. Have any families gotten poorer during, any of the richest families lost money during this pandemic?
Very much so, Matt. So very much contrasting to the Waltons, you compare them to the three of the families behind AB InBev, three of the families who helped to create that massive beer company. So during the pandemic, you imagine yourself, what you're wanting to buy. Beer maybe isn't top of your list because it's heavy. It's a real heavy item to have if you're going in the store, but also e-commerce. It's not something you'd necessarily buy online so much at the moment. So as a result, those families, they have slumped massively, losing about $16 billion this year. There's three families between them. Interesting to note, though, that they're now investing. The pandemic has prompted AB InBev to invest way more in e-commerce. So it's going to be interesting to see maybe whether this time next year we're talking about them being a loser again. Nonetheless, I wouldn't spare too much sympathy for them because they're still richer than more than the rest of us, I can tell you that.
It's really uncertain times. I mean, what's the outlook for these family fortunes? I know the Al Saud family's up there. I imagine the oil price collapse this year hasn't helped them. But what do we see for the second half of the year?
I think what we see for the second half of the year is a lot of focus on those big American fortunes as we near that US election. It's important to point that most of the fortunes, actually, the biggest chunk come from big dynastic American families. Obviously, the Walton leading the ranks there, but you've also got the Kochs and the Mars family in second place, actually. So a big reason for why these families keep on year after year increasing their gains is and passing down wealth across generations is really careful estate planning. Sam Walton gave away a chunk of his fortune well before he passed away. So it's very much at the forefront of families' minds about how they pass on their wealth. And something that Joe Biden has said that he might do is tighten sort of loopholes around estate planning. And that would definitely, I think, be something for these families as we sort of go to the second half of the year, be top of their minds. A lot of the rest of the world will be thinking about other topics, but for the big American fortunes, this will be top of the agenda, I'm sure.
It's a great list, Ben. Just looking through it here, I think one of the more interesting things is that you list the generations. So you get to see which are the oldest family fortunes. There's Van Damme, Cargill, Macmillan, Hermes, and then something like Al Saud's. I would never have guessed that it's such young money, only two generations there. Good stuff. Ben Stupples, Bloomberg wealth reporter, talking about that report. And I highly recommend checking it out online at Bloomberg.com. Now, Siemens Healthineers has agreed to buy Varian for about $16.4 billion, currently the biggest medical acquisition of the year. Bernd Montag, the CEO of Siemens Healthineers, joined Bloomberg TV earlier to discuss the deal.
It's a combination of a cash and equity raise, which will follow in due course, and this equity raise will create create also additional free float, which eventually will lift us in the DAX. We are very certain about this transaction. It's the right time, and we are also super confident about financing.
Bernd, great to speak to you this morning. As we speak, we've seen over the weekend tensions increasing between the US and China. China is an important market for Varian. How are you planning on navigating those tensions?
Yeah, Nira, thanks for the question. I mean, healthcare is, medtech is global, and Varian is a global company. I mean, with footprint in China, as also Siemens Healthineers has footprint in China, with a very strong position in China, with a unique strength also of more than 50% market share. They are catering an enormously important part for healthcare in China. So I'm very, very certain that when it comes to an essential topic like people's health, this will not be an issue politicians will touch.
Bernd, when we look at your relationship with Varian, it has extended over the past number of years, mainly in the radiotherapy diagnostics. So there's the complementary side of the business there, MRI and CT scans. Where will the biggest synergies come from? What's going to drive this deal forward?
So we have chosen the tagline, one step, two leaps for this transaction. It is a leap for Varian to become even broader in addressing cancer. So by putting together all the diagnostic aspects and aftercare aspects we bring to the table, and then by building a digital roof, if you wish, of combining all these into new insights, new knowledge, using our AI capabilities. Yeah, so a lot of the synergies are in co-innovating topics which before that nobody else would have been able to do under one roof. The second leap is the leap for Siemens Healthineers, because with this we become an even broader customer, a broader partner for our customers. We can basically address all major disease patterns, and our so-called value partnerships, in which we address customers holistically instead of just doing transactional deals for a certain product, will benefit a lot from this transaction.
Yeah. One benefit for you, Bernd, you've said to us just now that the deal will lift the company into the DAX. I'm wondering whether a dual listing will make sense for you from here, given that Varian is a US business and your diagnostics division is mostly there.
We feel very comfortable with the listing we have in Frankfurt, and I think there is so far we have not heard any let's say quote-unquote complaints of investors or any disadvantages from this. So I think it is in our investor community well understood that we are listed in Frankfurt, and a US listing is not planned.
That was Bernd Montag, CEO of Siemens Healthineers on Bloomberg Daybreak. We just had some breaking news crossing the Bloomberg terminal. Another PMI coming out for France. July manufacturing PMI 52.4, and this again beating the expectations, or the prelim was 52, so a little bit higher. And of course, anything above 50 is expansion. So we have France now, July manufacturing PMI. We're going to talk more about this coming up next, as well as how would fresh lockdowns impact equities. We'll put that question to Christine Aquino, who leads our MLive team here in Europe. This is Bloomberg.
Hi Gazim, what can I do for you? You can follow our trades and copy them. You don't have to pay anything at all, and you can use your own broker. And yes, you can see on our ticker that we still hold euro positions, and you can see how many positions are opened. All right? Feel free to ask any questions if you want, but don't ask about advice or something like that. We don't do this. We traders, day traders, so basically we don't give any advice. You can follow our trades by looking at the screen and to see what we buy and sell. All right?
Welcome back to the European Open. We're 53 minutes into today's trading session. FTSE 100 under pressure, but the DAX and the CAC are up, especially the DAX outperforming. They're up more than 1%. Joining us now is Christine Aquino, who leads our MLive team here in Europe. Christine, I want to start out with our MLive question of a day, and it's how would fresh lockdowns impact equities? What's your take?
Yeah, it's an interesting one, Anne-Marie, because I feel like markets have a mixed relationship with the idea of lockdowns. On the one hand, I think it would be beneficial longer term for the economy and, of course, the response of markets. If we see some lockdowns being taken place, that would be a signal that governments are getting a grip on the virus spread and really going for those measures that will nip this in the bud. But, of course, it's not going to be great short term for sentiment because in short term, it would be an indication that the governments are currently not in control of the virus, and that's why they're having to resort to such extreme measures. And when you take that into account of the extremely high valuations that we're seeing in equity markets, particularly in the U.S., it seems like a good recipe, at least for a pullback in the initial short term before we see a gradual recovery as we get those lockdowns impacting and bringing down the case numbers.
We are seeing PMIs come out. Spain, we've had, and France as well, both beating estimates. Now we're getting Germany also beating estimates at 51, all of them in expansionary, at least those three countries in expansionary territory. How important are these PMI manufacturing numbers to the markets?
Certainly very important, Matt. I mean, talk about a V-shaped recovery, at least when it comes to these PMIs, giving us an indication of how much this sector has recovered over the last few months, especially in Europe. What I would note, though, is that some of the details of the reports do show that there are still sustained job cuts in this sector, and that's going to be important going forward because, as we all know, the labor market is going to be a crucial part of the economic recovery of any country, and Europe is no exception. And so if we do see those sustained job cuts continuing throughout the rest of the year, that does bode some longer term risks for the economic recovery because that means, you know, it's a snowball effect for the consumer sector as well, and which would have an impact on the services sector. So you could be looking at quite an uneven recovery here and potentially a slower recovery if we don't see much improvement on the employment sector here.
Thanks, Christine Aquino, who leads our MLive team here in Europe, for joining us this morning. Matt, that's it for the European Open. We're relatively mixed with the DAX, where you're sitting, is outperforming this morning.
Yeah, it does look like the DAX is doing better than, well, certainly it's doing better than the FTSE, which is down right now. The IBEX is off, the IBEX 35 off 0.7% in Spain right now. The CAC 40 up a little bit as well. We are headed to radio. Up next on Bloomberg Television, it's Surveillance.
Global coronavirus cases top 18 million in the UK. The government reportedly considers sealing off London if infections spike. Missing the mark, HSBC shares dip on surging bad loans. We'll hear from the company's chief financial officer. And TikTok turmoil. U.S.-China tensions threaten risk appetite. Mike Pompeo suggests action to protect national security won't stop with one company. Well, good morning, everyone. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, the markets are moving on the back of a couple of these trade tensions, which we need to spend a bit of time on. We also have those Euro area PMIs coming in a touch better than expected, but really it's a touch, so I'm not sure whether it's moving euro dollar that much. So we're looking at crude oil at 39.80. It's always a good test looking at demand and actually what it means for the world economy. Euro dollar 117.64, and then we continue looking at earnings with a couple of disappointments in the banking sector. I'm thinking of HSBC, but also Société Générale. So that July manufacturing PMI coming in at 51.8 instead of the 51.1 that we were expecting. Now let's get straight to the Bloomberg. First word news here in London is Laura Wright. Hi, Laura.
Hi, Francine. The US plans to act against a wide range of Chinese-owned software companies, not just TikTok. That's the latest from US Secretary of State Michael Pompeo speaking to Fox News. On Friday, President Donald Trump told reporters he planned to ban the popular video app. No official decision yet, but Pompeo says it should come soon. The UK is considering the worst-case scenario of locking down London again. That's according to the Sunday Times. It would include travel curbs in and out of the M25 and would see at-risk people asked to stay at home. Local Government Secretary Robert Jenrick says he is not aware of any specific plans to seal off London, but that the UK will target local flare-ups rather than blanket action across the whole country. Global coal power capacity has fallen for the first time on record. That's as the closing of plants in Europe, the US, outpaced new units, mostly in China. The decline is just about 0.1% of capacity, but while it may be small, it marks a turning point in the history of the dirtiest fossil fuel. SpaceX's Dragon capsule has splashed down in the Gulf of Mexico with its 2 astronauts. It successfully concludes the company's first crewed mission to the International Space Station. It's also a return to US space travel for NASA. It's the first mission for the US astronauts in an American craft since the shuttle program ended in 2011. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg, Francine.
Thank you so much, Laura. Now, global coronavirus cases have surpassed 18 million. The pandemic is now adding 1 million infections every 4 days. It's prompting more lockdowns from Australia's state of Victoria to Manila in the Philippines. And in the U.S., a top Fed official is also urging Congress to take action as lawmakers remain divided on the next stimulus bill and current aid programs expire. Minneapolis Fed President Neil Kashkari says the surging U.S. savings rates mean that the country can afford to support Americans who have been laid off, while a hard lockdown could deliver a faster economic recovery. Well, joining us this morning is Ian Steely, International Chief Investment Officer for Fixed Income at JP Morgan Asset Management. Ian, great to have you on the program. How do you look at, the possible rising of infections with possible lockdowns and what kind of recovery you're expecting?
I still think it's, at the moment, the market, is when you look at the performance, is still focusing on the huge amount of stimulus that we're getting, both from the central banks around the world, but also now, continuing to be expected to come out of the US as well. And that really seems to be, at the moment, having a bigger effect than the rising intentions and the rising virus cases. And I think that there's just a huge amount of liquidity that's being injected and will continue to be injected for the foreseeable future is just overwhelming market valuations.
What does that mean actually for fixed income? Where do you find value given all these uncertainties?
So we've been saying for a long time that we want to be co-investing with the central banks. So that's finding the parts of the government bond market where there is still some yield. I would have probably said the 10-year Treasury had that a couple of weeks ago. Obviously, we're down at 50 basis points or so. But when you look out the curve, the 30-year part of the curve in the US, parts like Australia and New Zealand, there's some value. And then I think the market's got confidence, as we have, that the central banks around the world are going to continue to support the credit markets, particularly investment-grade credit. The Bank of England, the ECB have been doing it for a long time, buying corporate bonds. The Federal Reserve is now involved in that. And I think that's the area where there seems to be the biggest amount of focus. We're obviously seeing a lot of flows go into that market. And then really the challenge so when you actually really go down the credit spectrum into the high yield space is rolling up your sleeves and finding those companies that will still be with us over the next few quarters, because we are seeing defaults picking up, but that's where the value is, that's where the yield is, and I think that's where the hard work is going to be for us over the coming months.
How much more support can we see from central banks around the world?
I think we've heard very clearly from the central banks that they will continue to support the economies as it is needed. We heard that particularly from Jerome Powell last week. I think we'll hear it from the Bank of England this week. We've obviously had the increases from the European central banks over the last couple of meetings. So I do feel that the reality is, until we start to see improvements and still we start to see inflation picking back up and start to see unemployment coming back towards full employment levels, that the central banks will be there and that they will continue to do more if required.
Is there, how much more fiscally, Ian, can you see governments actually spend? Unless we get a stimulus in the U.S., are you much more cautious about the path of the U.S. compared to the rest of the world?
Yeah, I think the market is very
very much expecting a stimulus package. I think there's a big debate as to, obviously, there's pretty wide range between Republican and Democratic numbers at the moment. But I do think it would, in an election year, the political ramifications of not passing this package and not getting something through would be too great. So we would expect something from them. And then we've obviously got this huge European Recovery Fund that is going to be in play over the coming years. So I think the fiscal side is again going to be very, very supportive.
How do you view the possible lockdowns? I don't know whether there's a model that you prefer, if there's like a complete lockdown with support to basically keeping a lot of the companies that you were mentioning were hard to find afloat. Does that make more economic sense than gradual lockdowns with less support and less furlough money?
I think that the lockdown situation is interesting at the moment. I think there's going to be a real reticence to go to full lockdown. Again, I think we've seen the harm. Just looking at the Q2 numbers, we've seen how painful it's been for full economies going to lockdown. So what we're seeing here in the UK, which I think is a great example, is they're being very proactive now in the local lockdowns and targeted measures. And I would expect more of that. And as we've seen, in some areas where they have gone in quickly, we are starting to see an improvement in the virus cases. So I do think that is going to be the main path that governments will take, rather than have this full-blown lockdown that effectively shuts down the economy. Because I do think, the longer-term impacts of the economy as a whole being shut down is going to be too great, and the politicians are aware of that now.
Ian, overall, is there a region that you prefer to others? I know we mentioned some of the things that you like and where you find value, but do you break it also down in countries and regions?
I think there's been a big debate, Europe versus US, recently, and it's obviously discussed about across the equity markets. We've obviously in the euro do very well from a currency standpoint. I think maybe some of that, the negative news around the virus cases in the US and how much better Europe and the rest of the world was doing. Obviously, as we get pick up in cases in Australia, we've got these local lockdowns here in the UK. We're starting to see cases pick up in places like Germany and other spots of Europe as well. I think maybe that sort of dispersion or difference between the US and the rest of the world is coming in a little bit. I still feel that at least from a fixed income standpoint, the value to be had is within the US. I feel that that's where you can still get the highest yields for the major developed markets and the major credit markets, and I still feel it's the area where you get the most support, both on the fiscal side, which I do believe will be coming, but also the central banks. I feel that they are going to continue, the Federal Reserve will continue to support markets for as long as it takes.
All right, thank you so much. Ian Steely there from JP Morgan Asset Management stays with us, and we'll get to Ian in a second. We also have pound at 130, so I know it's something that we want to spend a bit more time with Ian Steely on. Now, coming up, SocGen extends its losing streak with a surprise $1.5 billion loss. In the second quarter, we'll hear from the French lender's Deputy Chief Executive Officer, Séverin Cabanne. That's coming up next, and this is Bloomberg.
is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Thanks, Francine. HSBC is warning of $13 billion of loan losses. That's as the lender missed expectations, with profit falling 57% from a year earlier. It's also feeling the weight of political turmoil in its key market of Hong Kong. It raises pressure on Chief Executive Noel Quinn to accelerate its overhaul of the bank. 35,000 job cuts are expected.
There is a substantial amount of uncertainty out there at the moment, whether it be geopolitics, whether it be Brexit, whether it be COVID. I think over the next 3 to 6 months, it will be important to see the impact of second, third wave and what impact that has on various economies around the world, and also what the path is to a viable vaccine sometime in 2021.
Societe Generale has extended its losing streak with a surprise loss of around 1.3 billion euros. It caps a tough period for the bank, which saw equities trading revenue decline 80%. Chief Executive Frédéric Oudéa faces increasing pressure. He's trying to reduce risks and increase profitability. Siemens Healthineers has agreed to buy Varian for about $16.4 billion in cash. It's the biggest medical acquisition of the year. The deal will be financed through debt and equity. It gives Healthineers a sizable market share in the rapidly growing field of cancer treatment. It also opens a potential path onto Germany's benchmark DAX index. And that's the Bloomberg Business Flash. Francine.
Thank you so much, Laura. Now, the Trump administration is expected to announce measures against a broad array of Chinese-owned software companies this week, not just TikTok. That's according to U.S. Secretary of State Mike Pompeo talking to Fox on Sunday. On the economic front, China's factory activity rebounded. The Caixin gauge shows it growing at a faster pace in July than at any point since January 2011. Well, still with us, Ian Sealing from JP Morgan Asset Management. Ian, how do you look at the U.S.-China trade war? How much worse can it be, and what kind of impact does that have on markets?
Well, I think you could argue that actually the markets have been relatively sanguine to it at the moment. When we saw what happened last year and the negative impact it had on the overall market's view and the destruction it was causing to equity markets at some point, is actually very tame at the moment. Now, obviously, this rhetoric could pick up and we could see a larger impact to the markets. But again, it comes back to, does the US administration really want this to be happening in a political year or an election year? Because we've got a number of other things going on when it comes to pick up in virus counts, the negative GDP print, the high levels of unemployment. Do they really need a big spat with China at this time going into the next few months? At the moment, the market is saying no. It's not going to be a big impact. But I definitely think if tones do pick up, then the market will have to sit up and watch.
Does it impact some of the supply chains, Ian? And so does it even make it more difficult to look at companies where you could find value?
Yeah, it does. And I mean, this is the big issue, because it's so difficult to just see what's going on around the world at the moment anyway, when you think about the virus, when you think about the possibility of further lockdowns, that it's just an added concern that really does make it a very challenging environment to invest in.
When will it be easier, the environment? I mean, generally, do you worry about inflation taking hold in 12, 18 months? And so is it even going to be more complicated now? Like, how has the investment landscape changed forever because of COVID?
I think when you look at what's happening to real yields, what's happening to gold, and nominal yields as well, with the high levels of unemployment rates at the minute, it seems a very challenging environment to really be concerned about inflation in the near term. Longer term, I think it's going to depend, and it's, I think, very much going to be medical driven as to whether we do get a vaccine and whether the global economy can really come out of this the other side, as to whether we do see that pick up in inflation. But for now, with the very high levels of unemployment and people out of work, you really do struggle to see inflation picking up. And I think when you look at the bond market at the moment and where 10-year treasuries are at 50 basis points, the market's saying exactly the same thing.
Yeah. If you look at the dollar as a reserve currency, will it lose its shine, Ian? And again, what does that mean for treasuries?
So I think that the dollar question is a very interesting one, because obviously we've seen this bout of dollar strength in the very first stages of this crisis, and then more recently we've obviously seen dollar weakness, and as you've been saying on the show, July, one of the a very bad month for the US dollar. Now, what I would say is, from that standpoint, the US dollar, there's a lot of the bad news is in the price. As I mentioned earlier, some of the negative news around virus, pickups in the US relative to the rest of the world, that is fading to a small extent. So I think the big dollar negative move, at least in the near term, has happened. But I still think the dollar still looks very, very much slightly overvalued on a longer term basis, and that we can continue to see in the more medium term some dollar weakness. And you might see some of those shifts in reserve currencies. And if you think about people who wanted to move away from the euro and move away from Europe as a whole, very, very concerned about what was going on within the Eurozone. Well, I think the action that we've seen from both the central bank and more importantly the recovery fund could well give people more confidence to go back and have another look at Europe. And Europe that has, or does appear at least for now, to have got its house in order, which again could see flow move in that direction.
Is there anything in Asia that you actually quite like? I don't know if there's anything from the Chinese side that you could be buying as a proxy.
Well, I think one of the things that's been interesting for us is the lack of performance of Chinese government bonds. If you look at 10-year Chinese yields today, we're up around 3%. And if you compare that to the other major markets, they say the US at 50 basis points. We know Germany deeply in negative territory. It does look attractive. Now, it's possibly the way that the Chinese are doing their stimulus measures very different to the support of the Federal Reserve. But in a world of low yields and this grab for income, when you're talking 3% for a market that is obviously growing in popularity, it's making its way into all the major indices. We expect there to be huge support for Chinese government bonds over the coming years. 3% is pretty interesting to us. So I do think there's something to be done there.
Ian, thank you so much. Ian Steele, their International Chief Investment Officer for Fixed Income at JP Morgan Asset Management. Now, coming up, welcome to the most volatile month. If history is any guide, investors are about to see the most turbulent time of the year. We discuss August and volatility next. This is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Let's get back to the markets. And equity bulls dealing with the pandemic and bleak economic data now have something else to worry about. August. Over the past decade, the summer month has proven to be the most turbulent, and if history is any guide, it's yet another risk for already vulnerable markets. Well, with the details is Bloomberg's Danny Berger. Hi, Danny. So break down the volatility that we're actually expecting.
Hi, Francine. So on average, every August, we see the U.S. and European volatility gauge rise by more than 2.5 percentage points. The typical month, we see a decline of 30 basis points. So this is definitely a standout month. The thinking here tends to be that it's summertime, so we're seeing traders go on holiday. There are just less people around, lower amounts of volume, lower liquidity, and that means that the potential for markets to get pushed around the threshold for doing so in terms of trades is much higher. Now, in some ways, this could also be a self-fulfilling prophecy. Traders know that August is coming. There's going to be volatility, so they start to prepare. They start to take on more protection. Interestingly, though, of course, we already know this is a difficult time for traders, given rising coronavirus case counts, difficulty getting stimulus through in the U.S., and just the economic turmoil. But according to one trading firm in Boston, that's Mishler Financial, they think that the rise of retail traders in the current environment will actually help settle markets because they tend to be more consistent as to which time of day they invest rather than just when markets open or close. So that consistency should help prevent some spikes and dips in the market.
Danny, what are we seeing traders do to prepare?
We're actually seeing a lot of flow into ETFs. Fran, I know that you watch this sector a lot. Volatility ETFs, so ones that when you buy them, you're de facto getting a long VIX position. Last week, we saw nearly $100 million get poured into them. That's the 6th consecutive week that we've seen these ETFs get inflows. So it's clear traders see some volatility on the horizon, because I should say most of these ETFs track the front end of the curve. That is volatility contracts that expire this month or next month. So this is near-term volatility we're talking about here. So it tends to be elevated at this point, Francine.
Thank you so much. Our Danny Berger there with the very latest on the volatility we're expecting. Now, coming up, as UK ministers are reported to have considered a London-wide lockdown in the event of a flare-up in the virus infections, we'll discuss how far the world is from an effective vaccine. Our interview with the UCL professor of virology, Dinan Pillay, is next. This is Bloomberg. Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Laura Wright. Hi, Laura.
Thanks, Francine. The White House and Democrats are still far apart on a new coronavirus relief plan. Talks will resume today. One of the key sticking points is the $600 a week jobless benefit. Democrats want to keep it in place, but the Republicans want to reduce it to $200. The deadlock comes as Fitch revised its U.S. outlook to negative, citing the lack of a credible fiscal plan. A hard lockdown could deliver a faster economic recovery. That's according to Minneapolis Fed President Neil Kashkari, speaking to CBS. He says while the move would be very unpopular, it could restore growth and hiring more quickly rather than waiting for a vaccine. Kashkari also said the surging U.S. savings rate means the country can afford to finance more fiscal aid. Global coronavirus cases have topped 18 million. The pandemic is now adding around 1 million new infections every 4 days. Australia has expanded its restrictions in Melbourne in an effort to curb rising infections in the city. New Zealand is now delaying its quarantine-free travel zone with the country due to the outbreak. James Murdoch is cutting ties to the family empire led by his father, Rupert Murdoch. That's after clashing over its editorial direction. He was chief executive of the family's main media business until last year. He stepped down when most of its assets were sold to Walt Disney. Since then, he's become increasingly critical of the conservative editorial direction at News Corp and Fox News. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Thank you so much, Laura. Now let's get the latest on the coronavirus and the search for a vaccine. The UK government is looking at all options for tackling localized flare-ups of the virus. According to a report in the Sunday Times, a London-wide lockdown is one of the scenarios under consideration by Boris Johnson's advisors. But how far away is an effective vaccine and a return to normality? Well, joining us now is Dinan Pillay, professor of virology at UCL. He's also a researcher for Independent SAGE, a group of scientists providing independent advice to the UK government. It works in parallel to the official SAGE group. So, Professor, thank you so much for joining us. Does the UK have a handle on the virus? Are we testing enough, and do we understand where it is?
Well, the UK has had one of the worst outbreaks and pandemics within Europe. And recent data demonstrate the largest number of deaths also over the longest period of time. So the UK has not had a good pandemic, and various reasons for that, but one of which is the delay in establishing testing and the development of structures that have taken some time to bed in.
What would be your advice right now to the UK government? What do they need to do differently than they have so far?
I think dealing with a pandemic is difficult, and I've got to say that for all countries, this is a unique circumstance. There needs to be clarity. There needs to be a lack of confusion on policies, and there needs to be public understanding and an acceptance, therefore, of some of the constraints that are coming in. I think what has happened is that messages have been confused, and against the backdrop of maybe inadequate testing, inadequate certainly being able to trace contacts and isolation of those contacts. In that context, the epidemic has continued. So I would say that two main things. First of all, to establish and make sure very rapidly that the structures in place for testing and contact tracing and isolating and supporting those in isolation are instigated. And secondly, a very clear, consistent messaging, which means that the public remain confident of government.
Professor, is a second lockdown in the cards, or is it going to be a more targeted lockdown? I don't know whether we can look at what's happening in the north of Great Britain and use that as a template of what could happen to London.
I think infections continue. There has never been less than about 2,000 infections a day within the UK. And so the time of the release of lockdown in the UK, at the time of that, there were more infections actually being underway than in many other countries across Europe, for instance, who started to release the lockdown. So whether we call it a second wave, whether we call it surges or local outbreaks, there continue to be continuing infections. And of course, what we're now seeing is that bursts of infections are associated with some aspects of the release of lockdown. For instance, social gatherings, particularly young people, factories, and those places where people have to go back to work. So this is, whatever we define it as, there needs to be very high level and consistent testing and tracing, and of course the ability to pass that data back to local authorities, local public health structures as soon as they can, in order that local containment can happen.
Professor, is it safe to travel right now, or is actually, outside travel what is spreading it further?
Well, if you mean travel within the UK, then clearly there is a big demand for travel. People understandably have been in lockdown for months. And with the government release of lockdown, of course, that has released a lot of tension, and people want to get out and about. Governments are actually recommending people, if possible, stay within the UK for holidays. So there is an encouragement to do that. And of course, there's the economic underpinning to that as well. But clearly, the most important thing is wearing masks, washing hands, the basic aspects of infection control, recognizing again that a lot of infections are still being transmitted, particularly indoors. So it's indoor settings that remain at risk. And I think the key thing, therefore, is that the population understand what the key infection control processes are. They're not complicated, but they clearly do interfere with normal life. Now, with regard to overseas travel, of course, we've recently seen in the UK that the acceptance of travel to Spain has now been truncated, and those people coming back to the UK from Spain have to quarantine, as for Luxembourg and Belgium as well. So it seems sensible to maintain travel within the UK just in order to avoid what potentially may be future lockdowns.
Great, thank you so much for joining us. Dinan Pillay there, Professor of Virology at UCL and researcher for Independent Sage. Coming up, a warning from HSBC, Europe's biggest bank, says loan losses could reach $13 billion this year. We'll be speaking to the CFO, and before that, we also have an exclusive conversation with the Moncler Chief Executive Officer, Remo Ruffini. That's coming up shortly, and this is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. This is what the markets are doing. The focus, of course, is on the virus. The focus is on some of the companies reporting earnings out there. And the focus is also on, for example, HSBC speeding up the shakeup of its global business, warning that loan losses may reach some $13 billion this year as it battles the economic fallout from the coronavirus pandemic. Now, a couple of things I'm watching back, for example, European stocks are down. Let's also focus on one of the sectors that is hit pretty hard by the pandemic. Earnings at Moncler, best known for its ski jackets, fell short of forecasts when the Italian company reported last week. It's another firm in the luxury industry struggling as the coronavirus shuts retail assets around the world. Well, we are very pleased to welcome for an exclusive conversation the chief executive of Moncler. He's Remo Ruffini. Mr. Ruffini, thank you so much. And I know you've been patiently, very patiently waiting for us. So thank you for joining us today. When you look at the coronavirus pandemic and how it changes the luxury sector in the future, how will it regroup? Are you going to have less shops? Will you have to sell more online? How will it change your company?
Honestly, is helping us a lot this moment, because I think, for sure we have to change mentality. The world is changed. I mean, first half was not good. As you know, the store was almost closed. 50% of the store was almost closed for a couple of months. But now I think we have a very strong opportunity in front of us. So we have the possibility really to rethinking about the new normal. I think new normal is much more digital, much more what we call omnichannel. I think now we need really to have the consumer in front of us, 360 degrees. I don't think it's anymore, the business not anymore wholesale, retail, digital. I think really is where to change the approach. I feel really the experience become much more important, and the transaction, I mean, could be in the store, could be online, could be through retailers, could be whatever it is. I mean, for sure, Europe and the United States is totally different than Asia, especially China. I think we have to adapt our strategy and speed our strategy to respect this moment. I think this is one of the most important things. Having said that, we cannot cancel what we did in the last year, but in the words, really we have to reshape and rethinking about almost everything, or speed our strategy. And again, I think it's very important to personalize the experience around all the contact we have with the consumer.
So what will be the biggest change for Moncler? I mean, your storytelling is really second to none. Your online presence is second to none. Will you accelerate that or focus on other things?
It's a lot of things. I think now we have directly operating e-commerce in-house from next year's. I think again, we really change. I mean, I think about the media spending, the marketing spending was basically traditional marketing spend. Today, we have totally different channels, totally different approach. We have the possibility to talk with the customer in a totally different way. We just did a project with Weibo last week, 30 million contacts, 30 million contact, I think, was a turning point. Now we have the possibility to not only to sell, because e-commerce is very important, but you have to change again the mentality. You have to try to talk with the consumer 360 degrees. That where they buy the product, I mean, is very important. It's not anymore concentrate on retail. I think is really to build up your own community. This is honestly I feel is the key. And without community, you cannot do anything. And then we must be able to talk with them basically every day. As you know, we changed our model of business a couple of years ago. Yeah. We are not anymore seasonal business. We are monthly. Every month we change our project, our content, our collection, our view of the customer. And then I think this helped us a lot already. Because we have already our strategy is already there. I think it's very modern. It's very for the today market, and I'm quite confident that we have honestly a lot of energy, because we really think there is a lot of opportunity for the next year and a half or 2 years going to come.
Mr. Ruffini, when you look at the recovery, or where can you see the recovery first? Are you seeing, people spending more in China on your products? Where do you see people actually starting to spend more than in the previous months?
honestly, the recovery somewhere is already there. You know, China is back. Honestly, China is already back. After the lockdown, they went back to the shopping mall, back to the e-com, and for sure, Europe is not easy because normally in Europe we have a lot of visitors. As you know, there is no traveling anymore. They're not traveling anymore. The good surprise, honestly, was United States. It's quite, I don't want to say good, but it's quite good, and it was, from my point of view, totally unexpected. I think the game is again, you know, you must recover. I don't think Europe is going to recover soon. I think Europe is really based on travelers, especially in the big cities as Milano, as Paris, and London. You know, but again, we have a new project we call what we call New Locals, that is online and offline, and I think we have to able to talk with the customer. They normally used to shopping around the world, and think about the Chinese. Normally 50% of the Chinese going to buy outside China. Think about all the Japanese, they go in Hawaii or LA or, you know, everyone, and we really try to talk with them in a totally different way and try to attract, you know, what we call the new locals, the people that used to buy outside, that today they are quite strong buyers inside the region. Again, it's Chinese recover very soon, and I think is going to grow a lot in the near future. And this is the way to work. You know, try to contact the customer. They're already your customer, but they used to buy outside. We have region like Hong Kong that is still, you know, in very bad condition, as you know, since a couple of years for the problem they have. But I think again, think about your community, build up a strong relation with your community, stay tuned with them.
So, Mr. Ruffini, do you think this crisis will actually lead to more consolidation amongst luxury retailers? Are we going to see mergers and acquisitions? And where does Moncler fit into this?
Well, honestly, I feel, you know, for wholesale, I think is moment is already in the United States is not as good as before. They will say, especially the department store, as you know. But again, if you think about omni-channel, you know, I think also companies small, independent like us, I think they could have a very good opportunity. For sure, the big luxury group is they are stronger. We know that, but. Again, we are small, but we are very flexible, very fast. I think we have the possibility to redesign our company for this moment. And again, I'm quite optimistic. I'm not an optimistic guy, but in general. But today I'm quite optimistic because I see around a lot of possibility. But you must be very creative in terms of everything, you know.
So, would you rule out buying something? I mean, do you want to get bigger?
Well, again, I always say Moncler is basically a startup because we opened the first store like 12 years ago, 2009. We have many things to do. Now we redesign all our digital strategy. Our e-commerce after use now is coming in-house. I think is a new challenge for the company. I think we have to learn to talk with this new language, you know, that is digital, physical experience, online, offline, means we have a lot of things to do. I never say I don't want to buy a company, but I never find a good opportunity. My thing now, I'm really keen to redesign my company, to redesign the brand, to have a new way to talk with the customer. That I think this is the key for me, a new attitude with a new approach for the market.
Mr. Remo Ruffini, thank you so much for your precious time, and we hope to speak to you very soon. The Chief Executive there of Moncler, Mr. Ruffini, joining us today. We'll have plenty more on the luxury sector here on Bloomberg. This is Bloomberg.
climate change is the defining issue of our time. So we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
We've incurred just under $7 billion of expected credit losses in the first half. You know, the businesses most impacted are the UK. We had $1.5 billion of additional credit losses in our UK ring-fence bank. And commercial banking amongst the customer segments, where just over $2 billion of expected credit losses. I think the big driver in the second quarter, though, was a very big shift, negative shift in terms of the economic outlook for the global economy in 2020, with a recovery in 2021, but not enough to offset the sharper recession that now everyone's expecting this year.
You're expecting about $500 million in cost savings in the second half. Is that program going to get accelerated going forward? And is sort of the targeted cuts of around 35,000 still going to be sufficient, or does that get changed? Does that need to be increased?
Well, we're pretty pleased with the progress we're actually making on cost. You know, we went into the start of the year at the full year results anticipating the costs were going to be flat. We're now signaling we expect them to be down at least 3% this year. We had a 7% reduction in the second quarter. It was flattered somewhat by very subdued activity in the bank on things like travel and some of our head office costs. So we're on track to deliver what we announced in February, which was a substantial cost reduction program over the next 3 years. We're pleased with the progress that we've managed to achieve in the first 6 months.
Ewan, look, you had that banner headline, 35,000 jobs to go. You paused, you've restarted. Is there a reality moment that we need to face that the job cuts and the reorganization is going to mean more than the 35,000 that you and Noel guided at the start of the year? We're looking at something much more substantial.
It was never a target in terms of headcount. Where the target was to take our cost structure down. We've had about just under 4,000 employees and contractors leave the bank in the first half of this year. We did what we thought was the appropriate thing to do back in March and pause that redundancy program. We restarted as of a month or so ago. You know, it's speculation as to how many people it will involve, but we do need to take costs down given the revenue pressures that we're now seeing in the bank as a result of COVID.
I mean, speaking of COVID, much of your guidance depends on a variety of scenarios coming from where the economic recovery is going to go from here. From what you see in the data, from the conversations that you've been having with some of your peers in the industry, what are the next 3 months going to look like?
I mean, there is a substantial amount of uncertainty out there at the moment, whether it be geopolitics, whether it be Brexit, whether it be COVID. I think over the next 3 to 6 months, it will be important to see the impact of second, third wave and what impact that has on various economies around the world. And also, you know, what the path is to a viable vaccine sometime in 2021. So I do think we'll learn a lot over the next 6 months or so as we approach full year results. We should also get some clarification on the path of Brexit as well over that period. And that's why we've come out today with quite a large range of expected credit losses this year of $8 to $13 billion.
Well, that was the HSBC Chief Financial Officer, Ewan Stevenson, speaking exclusively to Bloomberg. Well, Bloomberg surveillance continues in the next hour. Tom King joins me out of New York a little bit later. We'll also have more on the U.S. economy with the Dallas Fed President, Robert Kaplan. The markets are moving. The markets are focusing on some concerning news on the banks. We'll have a full roundup of the banks, but also tech stocks with TikTok. This is Bloomberg.
another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television. Global coronavirus cases top 18 million in the UK. The government reportedly considers sealing off London if infections spike. Missing the mark, HSBC shares dip on surging bad loans. We'll hear from the company's chief financial officer. And TikTok turmoil, U.S.-China tensions threaten risk appetite. Mike Pompeo suggests action to protect national security won't stop with one company. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacqua in London, Tom Keene in New York. Tom, a lot going on. You look very dapper, Tom, especially for a Monday morning. If you look at what the markets are doing, they're focusing on a couple of the banking stocks that actually disappointed in terms of earnings, and they're also looking at, what else we're doing in the world of treasuries.
Well, it's interesting right now. In terms of treasuries, we've got disinflation galore in America. The 10-year tips, Francine, breaking down to new lows. This is basically unimaginable. All that the backdrop of Washington. But to me, what's fascinating, Francine, is once again, and I say good morning to Nassim Taleb, we have been fooled by randomness. The story of the French banks this morning, Francine, is absolutely extraordinary.
Yeah, so there's the French banks, but actually, Tom, HSBC also disappointed, HSBC, which is why we're seeing a little bit of weight to some of these banking stocks in Europe. I know you want to start maybe with your data, Tom. I don't know what you're looking at, but I was looking
let's do
at
this.
Volatility for August. You start.
Well, let's do the data check right now as we go into August here, and of course the jobs report later this week. I like what Kit Jukes of SocGen says. He's not a derivatives trader. They are a structured products expert. Mr. Jukes says August has some risk to it. And we start out this morning with a churn. The market's lower, but NASDAQ 100 trading abruptly higher in America. We'll have to see how the tech stocks open. In the yield space, it's a jumble right now. Maybe early morning U.S. we're not there as we see, the churn in Europe and such. But the real news is the U.S. 10-year inflation-adjusted piece, negative 1.01. It breached 1 on Friday, or maybe it was Thursday. That's a huge indicator of disinflation. Francine, oil, American oil under $40 a barrel gets my attention. I'll let you chat up foreign exchange.
Yeah, foreign exchange is something that we're looking out for because the dollar seems to have trimmed some of the gains. Actually, pound also at 130. I haven't put it in my data check, but I need to do it shortly. If you look at the banks, so they're down some 1%. European stocks are turning higher. We did have some positive economic data, but then we also have some pessimism over the resurgence of COVID-19 cases. So it's going to be a pretty interesting week, Tom, to see what the market focuses on. And then we have central bank action later this week. Joining us now is Marvin Barth. He's Barclays Global Head of FX and EM Macro Strategy. Marvin, as always, thank you so much for giving us a bit of your time. What's the one thing that worries you most about the world economy? Is it the rise in infection rates or that central banks may do less than expected?
I think I'm more worried about the potential for the unexpected out there. I mean, if you look at the shock that we've seen, this is the largest economic shock in the last 220 years, somewhere between the second and fourth largest in the last 220 years. And the largest in the last 75 years. It is also a health shock. It is a psychological shock. it is going to engender all sorts of surprising, unanticipated, nonlinear results. And that's not priced into markets right now.
What will it take for that to be priced into markets, Marvin?
Well, I think we're going to have to start to see some of those events develop. We're starting to see that to some extent on the geopolitical front. Some of the things you mentioned in your headlines there, the increasing tensions between China and the U.S., some of the issues about what are Treasury prices really pricing in right now. Remember that that's the real yield that's actually dropped to that level. Actually, break-even inflation has gone higher implied in that, right? So you're talking about markets are looking for safety. That's why they're pricing in such cheap yields. And they're also worried, actually, potentially about inflationary outcomes despite the bad economic outcomes. That's not something we've seen in a long time.
Yeah, I mean, I get that it's a bipart market. I like the FT's article this morning on Turkish lira, but to me, Marvin, that looks so idiosyncratic. The fact is we're seeing loads of disinflationary indicators within economics and, frankly, within the markets, including the 10-year tips in America. Are the central banks pricing in enough disinflation?
So I think the central banks are doing everything that they can at this point. And, you know, what you're reflecting a bit in U.S. Treasuries is, remember that part of that yield reflects a safety premium, right? That people are looking for something to compensate themselves for the uncertainty they face elsewhere. What could be more certain in the world than coupon payments from a U.S. Treasury security? Whatever questions you have about that, that is one of the most certain things out there right now. And that's why it's commanded at such a premium. Remember, the price goes up, the yield goes down. So I wouldn't read so much into that about disinflation or economic outcomes. I'd read into that some level of fear and concern over the lack of certainty in the world.
And this, folks, explains right now this massive dollar-week, dollar-long disparity on the street. Where does Barclays fit in? I mean, are you looking at a resilient and stronger U.S. dollar, some mix there, or can you get on board the weak dollar call?
Yeah, I think we do actually seem to stand out on the street from what my understanding is. There are a lot of people who really decided that there is this weak dollar trend that has enveloped. I would say that's not the case. What we're seeing right now is that the dollar came off of its liquidity demand highs. We've also seen some really positive news come out of Europe in terms of a movement towards fiscal union. They have a long way to go, folks, so we're not there yet, but that seems to be priced in. We've also done some work to suggest that there are some increased optimism about European growth there. All of those things start to play into euro-dollar, which has led to a somewhat weaker dollar. But ultimately, in the background, we have to remember the U.S. economy is still doing better than most other economies in the world. It is still the safe haven, global safe haven. And so it's really hard for me to see a trend of dollar weakness.
What do you do with gold right now, Marvin?
Well, so I think gold is actually attractive, and it's one of the reasons why you've seen such a move in it recently. One is, remember that gold is effectively like a perpetual bond, so it should pay you the real interest rate. So to Tom's point about the falling real interest rates in the United States, gold should pay you the same price. For it to pay you the same price, the price has to rise, and that's what we've seen there. There's also an element of dollar weakness that comes into it, but there's another thing here, which is that uncertainty extends even to the U.S. So even though U.S. Treasuries look safer than other government bonds in the world, the fact is we all have questions at this point about how central banks are going to be able to handle all of this. This goes back to Tom's question. And that means that you should diversify into other safe assets, and that also is helping gold.
Marvin, when you look at, you know, the big question about dollar, will other, or, you know, the status of the reserve currency, will it come under erosion as time goes by?
So this is, I think, the most interesting question out there, Francine. I mean, the first thing is, I've been dealing with this question for 20 years. First of all, is when, you know, the euro came on board. Then it was with the rise of China. Then it was, oh, well, Donald Trump's going to undermine all of this. And what did we see back in March? In March, when people were really, truly scared, the only thing people wanted to hold, what went up versus gold, versus bunds, versus JGBs, versus everything, U.S. Treasuries, right? So for right now, it is the undisputed safe haven and reserve currency. But I do worry as we go forward, when you look at the debts that are coming out in the United States, when you look at the political factionalization that's coming out in the United States and the potential for how that could affect policy, then I do think that there is an increased risk of the dollar losing that in the future. But of course, the problem is there's no clear alternative. Until Europe actually does solve its fiscal union problem, it can't be a true reserve currency.
Marvin, if I look at the vector of yields right now, including the 2-year yield moments ago going down to its new recent low, 0.1053, do the central banks really have the tools to control the yield market, or far more importantly, to control the price of bills and notes?
Well, as we've seen with yield curve control in Japan and now in Australia, there is certainly the capacity for them to do that as long as they're credible, right? And so as long as markets believe that they are credibly pursuing their inflation targets and that they have the capacity to do this, then yeah, they can set those. I think the real concern, the thing, when I talked about at the beginning, we have to worry about all the unexpected things that we never imagined possible. One of those is, what if central banks lose their credibility around these issues? What if the massive amount of debt piling up in the background causes people to question whether this is actually monetization? At that point, then central banks are going to have a problem. We're not there yet, and I don't see that happening with any specific central banks right now, other than, as you say, like Turkey. But it is something we should be keeping in the back of our mind. This is not crazy talk at this point.
Marvin, thank you so much. Marvin Barth there of Barclays stays with us. Now let's get straight to the Bloomberg First Word News in New York City. Here's Ritika Gupta. Hi, Ritika.
Morning, Francine, Tom. Microsoft is trying to salvage a deal to buy the U.S. operations of TikTok. CEO Satya Nadella spoke to President Trump about how to secure the administration's blessing to buy the popular but besieged Chinese music video app. The president had floated the idea to outright ban TikTok on national security grounds. Now Bloomberg's learned the White House has given the companies 45 days to hash out a deal. The White House and congressional Democrats are still far apart on a new coronavirus relief bill. Republicans have proposed a temporary extension of the jobless benefits that expired last week. House Speaker Nancy Pelosi says Republicans are being condescending when they suggest the payment is too high and should be scaled back. The UK is reviewing its option for fighting coronavirus flare-ups. According to the Sunday Times, a London-wide lockdown is being considered if cases continue to spike there. Local government secretary Robert Jenrick says he's not aware of that plan, but he says restrictions imposed in northwest England show that the government will act when and where necessary. And NASA has completed a triumphant return to U.S. space travel. SpaceX Dragon capsule splashed down into the Gulf of Mexico with 2 astronauts. That capped the first mission in which American astronauts flew to the International Space Station on an American spacecraft since the Space Shuttle program ended in 2011. It was also SpaceX's first manned mission into space. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thanks so much. Coming up, a really timely conversation, this in the 8 o'clock hour. Mr. Kaplan of the Dallas Fed. There's so much going on, including the markets telling the Fed what to do, this new lower rate regime that we see. Robert Kaplan in the 8 o'clock hour. This is Bloomberg. Good morning.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
Good morning, everyone. Bloomberg Surveillance. Francine Lacroix and Tom Keene in London and New York to get the week started. Again, the jobs report way out there at the end of the week. Seems a million miles away. Kaplan coming up from the Dallas Fed here in a few hours. Right now, Marvin Barth with us from Barclays, also working in foreign exchange and EM as well. Marvin, I want to tie in here on something that last week I thought we really underplayed, and that is emerging market fiscal and FX dynamics. We know the Argentinian story. I think people have a really good grasp of Turkey unraveling. But as a general statement, what is the knock-on effect of a developed economy slowdown on EM?
Well, I think there's actually several different things going on here, Tom. We talked about it one time before, this idea that actually with the advent of increasing automation and AI, actually we've started to see over the last decade globalization unwind and production move back to advanced economies because it's actually cheaper to use robots than it is to use humans. And that was already undermining emerging market growth. Now they get hit by COVID, and the fact that you have slower demand growth in advanced economies, as you mentioned. And then on top of that, they, like everybody else, have taken out all this debt. And this is increasingly raising the risks for emerging markets.
I looked, Marvin, at the risks of EM, and, I thought Ambrose Evans-Pritchard nailed it in his piece in the Telegraph here. This confusion of liquidity with solvency, to me, is the story of August. Let's discuss that right now. Give us your sense of EM liquidity versus EM solvency.
Yeah, I think the distinction is really important there. And so what we are seeing is that as markets have normalized, as balance sheets have normalized after the shock we went through in March and April, there is a lot more liquidity in markets. It's much easier to transact. And I think especially with low yields in advanced economies, there is this siren's call of, well, should I go for these higher yields in EM? The irony is, of course, you're not even really talking about that much in EM anymore, right? With Brazil at 2%, what's that? And yet, in the background, as I just noted, their growth prospects have gotten significantly worse, and they've taken out a lot more debt. And so if you look, there are several countries in Latin America. There are the countries that you mentioned in terms of Turkey, South Africa is another one, where if you look at their savings and investment dynamics, these are countries that are not on sustainable savings paths. They are going to have to either cut back spending and consumption radically at some point, or they're going to run into some sort of debt problems.
What's your take, Marvin, on India?
India is actually one that looks relatively better here. They do have a high amount of fiscal debt, but they also have a relatively closed system for that, first of all. And second of all, their overall level of indebtedness at the private sector level is less. So as a country, if you look at the country balance sheet, they're in less of a savings deficiency than you would say, another high yielder like South Africa. So India actually looks like one of the better places to invest in emerging markets from our perspective right now.
Marvin, when you look at, dollar dynamics, I mean, how much of these emerging markets will actually suffer significantly in the next 2 months?
Well, this is a really interesting thing. I know that you and Tom, especially Tom, have been around long enough to remember that it's often the case that in August and September, that's when we start to get things really happening. That July is the month when everything calms down and we have low volatility, and then it starts to explode. And so I think, it's always hard to predict when you're going to get one of these events, one of these crises. You can't get the timing exactly right. But we do know that all the kindling is there. We have, as we said, poor growth conditions, lots of debt, potential policy issues, lots of potential for risk events globally, whether it's geopolitical or otherwise. And we have an environment where this could blow up. And this does look like exactly the time when we should start to see it. So I do think that there's a much greater likelihood of a rise in volatility, particularly in EM in the next couple of months.
Marvin, thanks for the brief. Nice way to get this Monday started for me. Marvin Barth is with Barclays as well. We've got a real mixture here of conversations on the politics of the moment and, of course, on investment and finance. But it is about a recalibration of economics. Over the weekend, the ideas of getting to September, getting to October in this pandemic, everyone's readjusting. We speak with Catherine Mann of Citigroup in the 8 o'clock hour. Stay with us worldwide. This is Bloomberg.
Everything around us, including the way we work and live, has been interrupted. Uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Bloomberg Surveillance. I'm Ruchika Gupta. Let's get the Bloomberg Business Flash. The Japanese owner of 7-Eleven convenience stores has agreed to buy Marathon Speedway gas stations for $21 billion. 7-Eleven is betting that an expanded U.S. footprint will deliver growth in the midst of the pandemic. Marathon is joining other energy companies in getting out of the retail business. It's the biggest medical acquisition of the year. Siemens Healthineers has agreed to buy California-based Varian Medical Systems for about $16.4 billion in cash. That represents a 24% premium to Varian's closing price on Friday. The purchase would boost Healthineers' presence in cancer treatment. And HSBC is warning that loan losses this year could hit $13 billion. Europe's largest lender posted second quarter profit that fell by more than half. Earnings slumped at HSBC's retail and corporate banking businesses. That was partly offset by rising income from the markets division. And that's a Bloomberg Business Flash. Tom Francine.
Ritika, thanks so much. Equities, bonds, currencies, commodities, red and green, real partition in the equity markets with futures fractionally lower, but NASDAQ 100 goes the other way. Very green, to say the least. Higher yields can be identified, but when you go short, and particularly when you go inflation or disinflation adjusted, it is remarkable. The U.S. 10-year tip, a negative 1.015. That is more negative than it was on Friday. You see oil breaking down above 40 there. West Texas Intermediate 39.77 as well. Francine?
Yeah, Tom, there are two stocks that we need to watch. So HSBC warning that loan losses may hit $13 billion as profit halved. Societe Generale also extended its losing streak with a surprise $1.5 billion loss, which is why it's impacting actually the European banking stocks. Overall, European stocks are turning higher. We had some better than expected economic data, but we also had a resurgence of COVID-19 cases. Coming up, we talk TikTok and tech stocks. So we speak with David Kirkpatrick, Techonomy Chief Executive Officer. This is Bloomberg.
the strategic future of the company. We're long past the stockpiling phase now in North America, and what we're seeing is big shifts from category to category. So things like hand hygiene growing very quickly.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
President Trump has said enough, and we're going to fix it. And so he will take action in the coming days with respect to a broad array of national security risks that are presented by software connected to the Chinese Communist Party.
The Secretary of State on something that is decidedly bipartisan, which is a great distrust of the Chinese, and of course that redounds onto social and onto technology in this discussion of TikTok. We began incredibly strong this Monday morning with not on the politics in the State Department, not even on the financials, but on the concept of this new social medium and where TikTok fits in. There's no one better than David Kirkpatrick. He's with Techonomy. His book, The Facebook Effect, was the definitive book on social for a generation. We're thrilled he could join us as he awaits release of The TikTok Effect sometime late this year. David, what is the TikTok effect?
Thank you, Tom. Well, actually, one element of the TikTok effect is that Facebook is facing competition that's more aggressive and effective than it has in perhaps a generation. So the TikTok effect also is one of making American political leaders deeply nervous because a Chinese application has basically penetrated the bedrooms and telephones of more or less all American teenagers. There's a number of other elements to it, but it's a pretty fascinating story and turning rapidly into the political realm.
Okay, so it's about Facebook and going after Facebook. Are we going to see other vendors, other parties come in here to take over the TikTok effect with Microsoft? Do you expect other bidders?
Well, that's a good question. I think it makes sense that others would be interested, but one of the things that, depending on how expensive TikTok turns out to be, which is hard to know, but say it's $15 billion. Let's just throw out a number that people have been in that vicinity speculating. Certainly Facebook couldn't buy it under these circumstances. Having, the hearing just the other day, they're clearly being targeted for antitrust, anti-competitive behavior, consolidation with another player not in the cards right now. Probably the same is true of Google. I think if Apple wanted it, I guess they could bid, but Apple has never done well with social. They don't really probably need it in some way. Why does Microsoft need it? That's an interesting question. I think Microsoft is a smart bidder, a smart company to want it. I think their growth opportunity there and their ability to buy it without any real antitrust issue is probably one of the main reasons they're interested.
David, if you look at what TikTok or who owns TikTok at the moment, I mean, a number of high-profile, American tech companies said they don't trust it, and so they don't want their employees to use it. I mean, what happens if it gets bought by Microsoft? Does the risk completely go away, or is it something that we should be thinking about?
Well, I think that in time, Microsoft could easily turn it into a completely American operation. They said in their very interesting statement yesterday, which they released sort of opaquely, all of a sudden Microsoft comes out with a fairly detailed statement. Yes, we're interested. We're going to make it into an American company. We're going to take all the data and bring it here. And they even sort of suggested they'd go through some kind of forensic process to determine whether any user data remained in China, and they would go to some great lengths to erase it there. That was one of the things their statement yesterday said. So I think people could be confident if Microsoft were to buy it that it would become more or less an American company. There are issues for TikTok from the standpoint of functionality and technology, though.
Who does it rival?
I'm sorry?
So talk to me about the challenges, and then I'll ask you who it rivals. If it's if it's bought by Microsoft, does it rival Instagram?
Well, it does rival Instagram increasingly, and I would say It has come up the tailpipe of the traditional social media companies in a way that no outside force ever has in certainly recent times. I mean, it's really, I think since, we thought Snap would become something I think it's become more threatening to Facebook than Snap, which is pretty surprising. Many expected that Snap would be the real looming presence.
David, one of the arch things here, and you've been so good at this over the years, is the ability to monetize along the way. You were brilliant on Facebook, and then the Instagram, folks, Sarah Fryer's book is out there vying now with David Kirkpatrick's book for best book in the world. Thank you. It's a good book. I've read it, yeah. Yeah, but, and think of the movies she's going to do with that. But anyways, David, I look at how you monetize, like eBay, how you monetize through eBay or Facebook or Pinterest and that. How do you monetize through TikTok?
Well, that's a great question because it isn't really a huge financial engine at the moment.
Exactly.
It's a company that's got huge scale, huge users, and it's not really a lot of business. They have in the last few months, maybe in the last year, been gearing up a partnership arrangement to be a broker for commercial companies to come in and do sponsored TikToks and brokering relationships. They don't really have conventional ads much at all. It's more sponsored TikToks. Exactly how TikTok gets revenue from that is not even always that clear. It has not been a company that's prioritized revenue and profit up to now. It's prioritized growth, which is what Facebook did, by the way, for a long time too, obviously.
Yes. Then how do you presume Microsoft will do an Instagram on this? How do they get it out 5 years? What's the
look at how Instagram turned into a profit machine relatively quickly once Facebook, bought it, as Sarah details in her book, and she basically would say, I think in her book, that Instagram has become overly commercial, overly fast. But the fact is, it can be done as long as you retain your audience. I think if Microsoft, as the owner, were able to retain the audience, there's plenty of ways they could expand TikTok's feature set and ways of working and bring customers in, commercial customers, and make a tremendous amount of money when you have hundreds of millions of eyeballs, which TikTok does, in a very valuable demographic, which TikTok does.
David, will it be at the expense of someone else? So if you look at Snap, Facebook, Twitter, even WhatsApp, I mean, if TikTok grows, who will lose?
Well, you just mentioned two of them. Certainly, Snap and Instagram are the companies that would probably be competing most head-to-head with TikTok for revenue. It's already starting to happen just a little bit. That's where TikTok's commercial efforts are being devoted, is to try to really make inroads against those two. It's not so much progress, but that Microsoft is an amazing commercial engine, and they would be able to do some very aggressive things if they chose. I also think from Microsoft's standpoint, the growth opportunity that this represents to get into the consumer realm and get some of that market cap that these other companies have achieved is kind of amazing, considering how gigantic Microsoft's market cap is as a predominantly commercial enterprise-oriented company already. Aside from the Xbox business, they really don't have any substantial consumer operations at the moment.
Thank you so much for joining us. David Kirkpatrick there, Economy Media founder and author of The Facebook Effect. Now let's get straight to the Bloomberg First Word News in New York City. Here's Ritika Gupta. Hi, Ritika.
Morning, Francine. Minneapolis Fed President Neil Kashkari is urging Congress to do more on the coronavirus and the economy. Kashkari told CBS the surging U.S. savings rate means the country can afford to support Americans who are out of work. He also said that a month to 6 week lockdown could lead to a faster recovery. A warning from White House coronavirus task force advisor Deborah Birx. She told CNN that the U.S. is in a new phase, saying the virus is extraordinarily widespread across rural and urban areas. Birx said that America is on the move during the summer vacation and the public needs to take more precautions.
Nobel Peace Prize winner John Hume has died. Hume was one of the chief architects of the 1998 Good Friday Agreement that brought peace to Northern Ireland. The deal ended the conflict amongst parliamentary groups and British security forces. John Hume was 83. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Francine, the BBC has out now the famous photo of Derry, Ireland from Another Time and Place. Richard Haas, who's with us so much, knows his cold, of John Hume standing in a street pushing back against police forces. And I just can't say enough about it. Francine, he is the only person who has ever won the Nobel Peace Prize, the Gandhi Prize, and the Martin Luther King Prize. No one else has done that. He's extraordinary.
Yeah, he was awarded, of course, the Peace Prize for his efforts in forging the Good Friday Agreement in Northern Ireland, but had suffered from ill health, Tom, for a number of years. I think he suffered from dementia and was cared for in a nursing home in Derry.
John Hume, the giant of Ireland.
This is Bloomberg Surveillance, Tom and Francine from London and New York. Now, the UK is looking at all options for tackling flare-ups of the coronavirus. According to a report in the Sunday Times, a London-wide lockdown is one of the scenarios under consideration by Boris Johnson's advisors. Now, this comes as the number of virus cases worldwide tops 18 million. Well, we're delighted to be joined by Stephen Riley. He's Imperial College London Professor of Infectious Disease Dynamics. Professor Riley, thank you so much for joining us. When you look at what's being talked about for London, you know, is this a full lockdown that would enclose London, or is it what we've seen in the north of the UK, you know, forcing households to limit the numbers of contacts with others?
So I don't think there are any specific details proposed for this yet, and I think that we've got to reflect a little bit on some of the recent local efforts. So, for example, they've had stringent interventions in Leicester recently, and then in kind of small areas in the north of England until that recent large area. And we've seen that they have been successful in terms of the cases have fallen after a period of time that those interventions have been in place. So I don't think it's clear in any sense what a plan might be for London, but we can look a little bit at what's been done in the other areas.
Are we testing enough in the UK? How's the UK doing after what many say was a pretty difficult start to dealing with the pandemic?
The testing capacity certainly seems to be very high in the UK, and the Department for Health announced this morning that they're bringing in a new technology, a kind of point of care or close to point of care technology that should be able to return individual tests even faster. I think there are two dimensions to the testing. There's the total volume, and then there's the speed with which you can get those results back to individuals. And I think the UK is pretty good on capacity and is going to be very good on that turnaround time quite soon.
Professor, you are expert in the history of all this. And you can go back to 1603 or 1625, call it the 17th century, and a whole set of plagues. One of the issues of the 17th century is everybody didn't go to the beach on the weekend. The modern disassociation of the medicine from the way people are behaving in society, I would suggest, is original. How do you interpret that, and how does it change what adults like you do?
So I think the thing that's different now is the level of information and the speed of information. We accept that in all other parts of our life. And so it works both ways. We're able to tell people when the risk is very high. We can tell them that their local hospital is struggling in its intensive care unit. We can communicate that risk very clearly, but we also communicate when the risk has changed. So we're in this very difficult position where, because the information is so good, people can see that change in risk, and we need the best possible messaging for people to continue.
But the messaging, great. I went out and read Camus again within the beginning of this in February and March. You got to reread The Plague every 5 years, or you're not gloomy enough in this business, Professor. But when you look at the history that we know, are you shocked at the behavior of politicians of saying, I'm sorry, the parallels here with the 17th century or Iran in 1946 are apt? Have the politicians just given it up?
I don't think they've given anything up. I think they're kind of looking for examples, useful examples, wherever they can find them, Tom. But I think the information flows. We've got examples more recently than this. We've got examples from SARS. We've got examples from MERS. We've even got examples, of Ebola, which was a very different disease. But the way that people's behavior responds to that information, we do have a lot of recent examples as well that I think we need to build on.
What have we understood, Professor, about the virus? I mean, do we really understand whether it's safe to go out to restaurants, whether it's safe to reopen schools, whether it's okay to meet in parks?
So I think we know that the risk is linked to how many people are going around and are infectious with the virus. And in different parts of the world, there are very different levels of risk. So opening schools is a great example. Schools are important. They provide, crucial support for our children, as well as just the education. But it's a different proposition to try and open them in an area of very low prevalence compared to opening them in an area of much higher prevalence. And those are things we've got to weigh up.
Stephen, you're the best guy in the world of going urban to rural in virology. Here's a fact. I put this out on Twitter this weekend off John Burns Murdoch's work at the FT. Take log per capita Bolivia, Honduras, in the United States of America, and they've got roughly the same slope of deaths. How in God's name did a per capita nation of $62,000 per year equate itself with Honduras at $2,500 and Bolivia at $5,000? How did the U.S. get in that position?
So for me, the most important features are the timing of those initial lockdowns and the strength of those initial lockdowns. And there was a lot of variation around the world in both of those. So the US went relatively quickly, but was in relative terms was not able to achieve the same strength of lockdown. There is a lot of testing in the US compared to some other countries, but it's clearly not just driven by US testing. but I think the lockdown was, for many reasons, they weren't able to get enough people to change behavior for long enough.
Professor Riley, thank you so much. Thrilled that you could be with us this morning. Francine, I want to note that Italy nailed this. I look at the same mathematics for Italy, and basically Italy is the triumph while America fails.
Well, Tom, a lot of people at the time, of course, thought that Italy was putting its, economy on its knees. So it proves, but then again, things could change really quickly, that if you completely lock down, maybe the damage is less because you keep a handle on it and then can reopen quickly. But again, we're August, 3rd. Let's see what happens September 5th in Italy and other countries as well. Coming up in the next hour, Dr. Joshua Sharfstein, Johns Hopkins Vice Dean at the Bloomberg School of Public Health. We're looking forward to that conversation as we continue tracking COVID-19. 6:30 a.m. in New York. That's 11:30 a.m. in London. We'll be speaking to Dr. Sharfstein. This is Bloomberg.
As it stands right now, we are seeing too many people, for whatever reason, attending work with symptoms. That just cannot continue. Otherwise, these restrictions will be in place for longer than they should be. And I'm sorry to say, we will see more people die.
When community transmission takes place, it is inevitable that it will find its way into the more vulnerable parts of our community, and the aged care community is certainly one of those.
Certainly, these are very challenging numbers. We're at a very challenging stage with this wave. There's probably not a country in the world that has gone through a second wave that hasn't found it particularly challenging. It has very different and complex elements to it that make it quite difficult to manage.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
Europe does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
Many bank stories today. HSBC, a more traditional story of losses. Let us listen to their chief financial officer.
We've incurred just under $7 billion of expected credit losses in the first half. The businesses most impacted are the UK. We had $1.5 billion of additional credit losses in our UK ring-fence bank. And commercial banking amongst the customer segments, where just over $2 billion of expected credit losses. I think the big driver in the second quarter, though, was a very big negative shift in terms of the economic outlook for the global economy in 2020, with a recovery in 2021, but not enough to offset the sharper recession that now everyone's expecting this year.
Ewan, you're expecting about $500 million in cost savings in the second half. Is that program going to get accelerated going forward? And is sort of the targeted cuts of around 35,000 still going to be sufficient, or does that get changed? Does that need to be increased?
Well, we're pretty pleased with the progress we're actually making on cost. You know, we went into the start of the year at the full year results anticipating the costs were going to be flat. We're now signaling we expect them to be down at least 3% this year. We had a 7% reduction in the second quarter. It was flattered somewhat by very subdued activity in the bank on things like travel and some of our head office costs. So we're on track to deliver what we announced in February, which was a substantial cost reduction program over the next 3 years. We're pleased with the progress that we've managed to achieve in the first 6 months.
Ewan, look, you had that banner headline, 35,000 jobs to go. You paused, you've restarted. Is there a reality moment that we need to face that the job cuts and the reorganization is going to mean more than the 35,000 that you and Noel guided at the start of the year? We're looking at something much more substantial.
It was never a target in terms of headcount. Where the target was to take our cost structure down. We've had about just under 4,000 employees and contractors leave the bank in the first half of this year. We did what we thought was the appropriate thing to do back in March and pause that redundancy program. We've restarted as of a month or so ago. You know, it's speculation as to how many people it will involve, but we do need to take costs down given the revenue pressures that we're now seeing in the bank as a result of COVID.
I mean, speaking of COVID, much of your guidance depends on a variety of scenarios coming from where the economic recovery is going to go from here. From what you see in the data, from the conversations that you've been having with some of your peers in the industry, what are the next 3 months going to look like?
I mean, there is a substantial amount of uncertainty out there at the moment, whether it be geopolitics, whether it be Brexit, whether it be COVID. I think over the next 3 to 6 months, it will be important to see the impact of second, third wave and what impact that has on various economies around the world. And also, you know, what the path is to a viable vaccine sometime in 2021. So I do think we'll learn a lot over the next 6 months or so as we approach full year results. We should also get some clarification on the path of Brexit as well over that period. And that's why we've come out today with quite a large range of expected credit losses this year of $8 to $13 billion.
HSBC, very, very different from what we see from the French banks. We'll cover that in the next hour. Stay with us. This is Bloomberg. Good morning.
Fiscal policy actions that have been taken thus far have made a critical difference to families, businesses, and communities across the country. And it will take continued support from both monetary and fiscal policy to achieve that.
The Fed really can't stimulate the economy very much when people don't want to borrow and businesses depressed and so on. What they can do is make sure we don't have a financial calamity on top of the real calamity, which they've been doing very well and will continue to do. We need fiscal support.
It also is a very important step in dealing with inequality, ultimately inequality and the institutional biases that are baked into the cake of our economy.
I wouldn't be surprised if we did get the scenario Tom and I were talking about, that the market would just take over and drive interest rates into negative territory, even without the support of the Fed.
Some things you see coming, some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
The volatility in the first two quarters were quite exceptional this year.
Part of it is participating in the better market opportunities that have existed in the second quarter, and we do expect a normalization of that.
The situation out there is still very challenging and very difficult to predict, so we should never be complacent.
This morning, do the math, the French banks, well, they've been fooled by randomness, or at least a singular black swan of the pandemic, from BNP Paribas to this morning's SocGen, perhaps tonight in Texas. There are massive losses as, quote, structured products become less structured. Do the math again. 30 million are without unemployment checks. The president is, quote, determined to spend what we need to spend. Select Republicans, well, they agree to disagree with their president. And oil back under 40. America disinflates. Good morning, everyone. This is Bloomberg Surveillance from New York. Francine Lacroix in London as well. Francine, I find the French banking story over the backdrop of French GDP, and for that matter, European GDP, just to be extraordinary. What a shock from Societe Generale.
Yeah, Tom, I think there are two shocks in the banking world today. One of them is definitely Societe Generale, and we spoke to the deputy CEO. We also spoke to HSBC because they also warned of loan losses hitting some $13 billion. Now, look, Societe Generale is very simple. It's just they had a huge loss, $1.5 billion of loss, and they also posted some one-off costs. So we need to dig a little bit deeper, and you know whether Societe Generale is a template of things to come for other European and especially French banks.
You know, very interesting, and for our global Wall Street audience, just amazing to once again see the failure of derivative strategies. We're thrilled that Jonathan Tice is scheduled to be with us later in the hour on the derivative structured product losses at SocGen. Right now, in New York City with our First Word News, here's Ritika Gupta.
Morning, Tom. Francine. Microsoft is trying to salvage a deal to buy the U.S. operations of TikTok. CEO Satya Nadella spoke to President Trump about how to secure the administration's blessing to buy the popular but besieged Chinese music video app. The president had floated the idea of an outright ban on TikTok on national security grounds. Now Bloomberg's learned the White House has given the companies 45 days to hash out a deal. The White House and congressional Democrats are still far apart on a new coronavirus relief bill. Republicans have proposed a temporary extension of the jobless benefits that expired last week. House Speaker Nancy Pelosi says Republicans are being condescending when they suggest the payment is too high and should be scaled back. The UK is reviewing its options for fighting coronavirus flare-ups. According to the Sunday Times, a London-wide lockdown is being considered if cases continue to spike there. Local government secretary Robert Jenrick says he's not aware of that plan, but he says restrictions imposed in northwest England show that the government will act when and where necessary. And NASA has completed a triumphant return to U.S. space travel. SpaceX Dragon capsule splashed down into the Gulf of Mexico with 2 astronauts. That capped the first mission in which American astronauts flew to the International Space Station on an American spacecraft since the Space Shuttle program ended in 2011. It was also SpaceX's first manned mission into space. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thanks so much. What is tech going to do with all that money? Well, here's one idea. Moments ago, Google announced it will take out a near 7% position in ADT. This is not ADP of New Jersey, the huge payroll processing. This is the security company of Florida. ADT is in Tom. ADT. And they're going to do a leading smart home security offering. That's how it's spun this morning. Of course, this comes off Google Nest and the such. But a really interesting idea of what are they going to do with all those cajillions of dollars. We'll have much more on that. I'm sure Emily Chang will kill this afternoon on Bloomberg Technology. I'm going to kill a data check right now. Mixed market with NASDAQ 100 up. You got to believe you may see a further advancement off the Google news. And I would really note the disinflationary tendencies of bonds still low yield, and the tips yield well under a negative 1%. That gets my attention. Francine?
Tom, I'm looking at French banking. I'm also looking at UK banking, given we had some HSBC figures. And so in general, if you look at what the markets are doing, European banks are under pressure, but actually stocks are gaining. Now, August traditionally, especially in Europe, is quite volatile. So I want to show you what VIX was doing at the moment. There's positive economic data, and that's countering pessimism over a resurgence of COVID-19 cases. Still, risk appetite remains relatively muted, Tom.
Very good. There is a jobs report on Friday, and of course before that on Thursday, this incredibly important high-frequency claim statistics that we get. We're going to do a lot of economics this week as economists struggle to recalibrate in this pandemic. Andrew Hollenhorst is in charge of pandemic recalibration for Catherine Mann at Citigroup and joins us today. Andrew, let's start with something easy. What's your unemployment rate call for Friday?
We think we're going to go down to 10.1%, so a lot of uncertainty around it, but it looks like it's going to be dropping again.
If there's that kind of improvement, why do we feel so miserable?
Well, because you're improving to 10.1%, which is historically one of the highest unemployment rates that we've seen. So I think that's what's so difficult here is that we've had this tremendous delta in terms of improvement, but it's still improvement to a level of activity, a level of employment that's well below where we were pre-COVID.
And of course, Andrew, folks, as a grizzled pro, goes right to the heart of the matter, which is there's a change along the way and there's a level. Do you and Citigroup just believe we will settle in at a reduced level off where we were on Valentine's Day?
I think we're pretty clearly going to level off somewhere below where we were before. We know that very clearly in areas like travel, in areas like restaurants that have had difficulty getting back to normal levels of activity. We know that's going to be with us for some time. The big question is around the other areas of the economy. How much can those other areas rebound? You have some certain sectors, housing is probably the best example, where we've almost fully rebounded already, but I don't think we're going to see that across the board in the economy.
Andrew, good morning from London. Are people saving or are they spending?
Hi, Francine. Again, it's an issue of levels and changes. So we've had this historically very strange scenario where you had government stimulus that was essentially replacing incomes. You had consumption that was greatly reduced because of what was going on due to the public health scenario. And that led to very high savings rate. But that savings rate is coming down. So it's still at a much higher level than we've seen historically. It is good news to see the savings rate coming down. It shows that people are going out and spending some of that money that's been saved, and that's boosting consumption. So that is something that we're really watching and hoping to see that savings rate actually continue to come down as you have people going out and spending again.
Andrew, what will the winter months bring? We don't talk often about seasonality, but are people going to be reluctant to actually spend even more as we go into winter, which means, shorter days and maybe more uncertainty of COVID-19?
It's a great question, and that's one of the issues that we have with the data right now is that all of the seasonal adjustment is based on kind of normal business as usual behavior. We know that this winter may look quite different than winters that we've seen before. We could have very different public health scenario. We don't know what that's going to look like. So seasonally, things could look very, very different this year than what we've seen before.
Andrew, to change gears here, I put out a tweet on this weekend off great work at the New York Times and the University of Chicago on what is an appropriate unemployment check. The number we're working with is 600 a week, which is a lot of money. Have you guys come up with a monthly aid statistic for all of the United States that would be intelligent for fiscal policy?
Yeah, so I think as economists here, you just want to be humble and say, yes, we have some theoretical models, we have some empirics, but no one, Tom, can tell you what the exact right number is. And probably where there's actually more agreement is not around what the exact number should be, but that some amount of continued stimulus, some amount of continued income replacement is really what it is. Because
yes, thank you.
People,
I'm going to steal that from you. Income replacement. Okay, Andrew, what is the impact to your work that on this Monday morning in August with the rent due, millions of Americans have lost their income replacement? What does that do to your spreadsheets?
Yeah, so that creates a huge discontinuity in the spreadsheet, literally creates a huge discontinuity in the spreadsheet where you have income levels that are falling off. Now, if this is very short-lived, then it's probably not a huge negative for the economy. So if this really is going to be a week or a couple weeks, and then the checks start coming out again, still has some negative implications, but that's a lot more positive scenario than if this is actually a prolonged period where you don't have these benefits that are coming through. So it's very frustrating that these things always come all the way down to the limit, to the deadline, and we're past the deadline now with this unemployment insurance, enhanced unemployment insurance having expired. So very, very important because you need those incomes to support consumption.
Andrew, will the U.S. dollar remain a reserve currency in the next 10 years?
I think it will. I think we can actually be fairly confident in that, just given the deepness of U.S. fixed income markets. There really is no substitute for what the U.S. dollar offers. But will we, probably on this show, over the next 10 years, continue to have a conversation about the changing role of the dollar, about the dollar continuing to be a reserve currency, but other currencies also starting to receive larger allocations as those markets grow? I think that is a